Good afternoon and welcome to this week's macroeconomics analysis session for September 25th, 2015. Joining you this afternoon is David and Jeff. How are you, Jeff?
I'm good, thank you, David. Hello, everyone.
Certainly hasn't been a lot on news come out from the Australian market this week, but certainly some information out of China I think that you might allude to throughout the course of this afternoon, Jeff. So very curious to hear your thoughts on what's happening in China at this point in time in particular. The disclaimer: the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation or particular needs before making an investing decision based on the general advice presented in any of the Elite Wealth presentations. Please consider whether the advice is appropriate in light of your financial circumstances. Alrighty-ro, let's get things underway. The week in review, Jeff. Obviously, we just mentioned there China. A little bit of data coming out of the US, and certainly this coming week. That's next week. A lot of talk coming from the Fed. Lots of different speakers over the course of the week ahead of us. A little bit of data coming out of the Eurozone as well. What's the important information topical in this last week, Jeff?
Yeah, look, we'll start at the top with the big one first. So the flash PMI out of China. I held a session for my members yesterday, and I spent a good 5 minutes talking about just this one individual item. So for some of you might have heard this already, so you can probably tune out for a few minutes, but for the rest of you, definitely wanted to go into it again. So you probably hear about flash PMI, and I mentioned pretty much every time we covered in these macro sessions, it's probably the most important piece of economic data out of China. A lot of the headlines go to the GDP growth numbers in China, and that's big picture, but by the time those numbers are released, it's really old news. This PMI, in particular, the flash PMI, what it actually is it's an indicator of what the manufacturing sector, what the factories are up to, and it's actually a survey. So it's a survey of purchasing managers at these factories, the people in charge of managing orders and ordering new stock and inventory levels and things like that.
Yep.
So they get asked a whole bunch of questions in this survey. What is your output like? What's your orders like? Your new order levels? Prices, input prices, export prices, output prices, export orders, all the employment levels, so hiring and you laying off staff, etc.
Yep.
And they put all this together and come up with basically a number. And a number of 50 means that the conditions are the same as they were the month before. A number above 50 is good and suggests that things are getting better. A number below 50 suggests that it's getting worse. So this number came out at 47, which is the lowest it's been in 6.5 years. So it's a very significant reading. And so not only is the Chinese manufacturing sector going backwards, but it's going backwards at an even faster rate
Than first thought.
than it has been in previous months,
times, yep.
and also worse than people were expecting.
Yep.
Why do we care about Chinese factories, I guess is the question. A couple of reasons. First of all, these PMI numbers are released all around the world, so they're actually important for most countries, but especially so for China. The reason why the data is so good is that manufacturing is very early on in the chain. So if you think about it, if you're in America and you're a retailer and you see people are starting to spend a bit more money, what do? You put in an order to manufacture more goods.
Yep.
You send that off to China. They get their orders. They spend however long manufacturing the product, checking it, testing it, sending it off to America. There's the shipping, goes to the warehouse, etc. Spends however long getting to a store, and then it gets purchased. It could be 6 months down the track. And so when you look at, say, American retail sales, that's an important piece of data, but it's quite late. It's the last piece of the puzzle.
Yep.
This shows signs much earlier.
Sure.
So it's what we would call earlier in the chain. And China's very important, obviously. About half of their GDP comes from manufacturing. It's the second biggest employer after agriculture. And if Chinese factories are going backwards, that generally means that the Americans and Europeans are not ordering a lot of goods from them.
Yep.
So I call China sort of the world's factory. And if their factories are going backwards, it's a really worrying sign for the rest of the world. On top of that, it has extra importance for Australia, because if factories in China are expanding really quickly, they've got all these orders, they need to make all these products, they need to order raw materials in order to make them. They get a lot of those raw materials from Australia.
Yep.
So we saw this PMI data was bad. The Aussie market got clobbered. The Aussie dollar got clobbered. Mining stocks got absolutely smashed this week.
Yep.
Market was down 2%. Mining stocks were down 6% this week. So this PMI is the most important indicator in China. Really important for the globe. Really important for our mining sector. And right now, it's looking pretty dire.
Okay, but this data, Jeff, 47 versus 47.6, Chinese PMI has been coming down for a little while now.
Yeah, look, the PMI has actually been bouncing up and down. Whilst you've seen a lot of indicators out of China have been coming down for 5-6 years,
Yep.
This is one that, because it's not so much, it sort of compares just to the previous month. So you will get times, even in the last couple of years, where it's gone up above 50 and then back below and up above. It tends to jump around.
Yep.
Sort of around 50, not too far away.
Yep.
So if you see something below sort of 48,
Yep.
it's actually a pretty serious sort of slowdown. So it is quite
Yep.
significant.
So you mentioned there, obviously, materials-based stocks or your miners and things like that. There hasn't really been too many reasons why you would want to be investing in that sector in any case. For a number of years now, they've been particularly weak, and yet you'd have to question why would people be holding those in their stock, other than having an extremely long-term view that those sectors were going to turn around sort of cyclically or whatever on a fundamental basis. But the world just doesn't seem to be rolling in that direction at the moment, does it?
Yeah, so I mean, this is an interesting one. So look, in my portfolio in the Elite Investors Club, we've got a little bit of resource exposure, but not a lot.
Yep.
It's really a small portion of the portfolio, much less than the market. And if I had to pick it, look, I would say that we are closer to the bottom of the resource cycle than the top.
Yep.
So if you were taking a really long-term view, look, it certainly wouldn't be reckless to be thinking about buying something now. But if you're buying in expecting a turnaround, in the shorter time frame, I think you're asking for trouble. I mean, I actually ran my workshop recently. One of the parts of my workshop where I teach people to analyse the market is I teach people how to look at an individual sector, and I use the mining sector as an example. Mm-hmm. And there's 5. I won't give away all my secrets, but there's 5 indicators that I look at to tell me, is it a good time to be in the mining sector or not?
Yep.
4 of them said no. 1 of them said yes. And that one I will give away was just the fact that the Aussie dollar was low, and that's actually good for the mining sector.
Yep.
And that's completely out of the mining sector's control. But the other 4 basically said, no, it's not a good time for the mining sector.
Yep.
So I think, I don't like to put a time frame on it, but probably in the next 12 to 18 months, there'll probably be a time when it'll be good to get into the mining sector.
Yep.
But I'd see those signs first and then jump in.
Sure.
A lot of people jump in and then hope it turns around.
Yeah. There's a big difference, isn't there, between doing some actual proper fundamental analysis or even technical analysis as opposed to just hoping.
And just going, oh, BHP looks cheap.
Yeah.
Oh, look how much Rio Tinto's fallen. I should buy some.
Yeah.
Certainly, you'll look at a chart and say Rio Tinto can easily continue falling, and I'll look at these indicators and say Rio Tinto can easily continue to fall, and I'll wait for some signs to buy, and you'll wait for some signs to buy, each in our own way before we make that leap. And it's that, and then it's not a leap of faith; it's actually got some evidence behind it.
Yep. Okay, so US there, Jeff. Any particular sets of numbers there that surprise or lead you to think one way or another in terms of what the Fed's going to say this week?
Nothing game changing. I mean, obviously the home sales came in a bit below expectations. I predicted the durable goods would undershoot, and it did, but certainly not. It's not a game changing thing. Unemployment pretty standard.
Yep.
Look, Yellen's talking tonight, and has made some comments during the week, and this is just following. And do you know what? I might just pause that because there's some more coming up next week that we'll talk about.
Yeah, okay.
But certainly, I've got some comments on the Fed in a minute.
Yep.
In the euro, I said that I expected most of these to go backwards, and for the most part, they did fall during the month.
Yep.
Importantly, German IFO business climate survey was a little bit ahead of expectations, but they were all roughly in line.
Sure. All right, well, let's. We've discussed things sort of from a fundamental basis. Let's just have a look at a few technicals on the chart at this point in time. Last week, you might remember, we were looking at the Australian market in particular and talking about this extended downward channel type of movement, where previously we'd moved out of it, we've fallen back into it. Again, just testing the upper and lower ranges of this downward channel at the moment. We're still in extreme risk territory as we speak. And the market sort of, even today, I think down a bit prior to just doing the session there, Jeff. But importantly, from this, we've still got a series of lower peaks all the way through, which from a technical point of view is quite weak. We've still got lots of supply in the market. The market's got to try and find a bottom sooner or later, and the question is when is that going to occur and what's that going to look like? Certainly from a risk perspective, we've got our stochastic down the bottom here, and as it's progressively got lower and lower and lower, it's been saying to us all the way through every Monday morning that we need to look after our capital, manage our risk, reduce our exposure wherever we can. If we're stopped out of any trades along the way through a broader market weakness, we don't refill the portfolio with new trades. And certainly one of the feedbacks for the ETC clients is the scans that you do every week. There are less and less opportunities being presented through those scans, and again, that's just market feedback telling us that there's not a lot of strong stocks out there. I am quite surprised that there is still a number of stocks in the ETC watch list that are hanging up quite well, holding up quite well, I should say. And one of those, Jeff, has been your long-time favourite, Capilano Honey, and Blackmores is another one. Obviously, both the China thing has been very beneficial for them.
Yes.
And I did hear today that Capilano Honey is expanding its online presence into China as well. So certainly they're after their vitamins and healthy sorts of honey, I think.
There's a couple of other stocks in the sector as well. Just a good example, Bellamy's, if you look at a chart of that.
Exactly. Yep.
And that's actually a lot of that demand is coming from Asia.
Yep.
So, yeah, I mean, there's all... This is something that I talk about and I preach a lot. There's always some good stocks out there in any market condition.
Yep.
And again, so I look at it on fundamentals. If you're in the right space, in the right sector, and you've got a good product,
Yep.
To an extent, it doesn't matter what the market's doing.
Yep.
And certainly, from your technical perspective, you've got stocks that are breaking out, outperforming stocks that you've been in a while and are still not pulling back to their stop loss levels.
Yep.
So if you've got that system to tell you, probably to scale back in bad market conditions, but that doesn't mean that you can't still have stocks have
to the market that are holding up.
Yep.
Yep. Exactly. So that's the XJO, our current market. It's still got a lot of work to do, and obviously the impact on China is having a huge impact on our markets there. The S&P 1500, again, we've talked about this trying to move back in an upwards direction. Last week we did talk about the reference to candles and Japanese market history, if you like, each candle representing, if you like, a soldier. At this stage, we've still got a dominant candle way up here at the moment. It's hasn't been challenged at all since that sort of market meltdown a while ago. We've tried to move back up. We've challenged the next biggest, most bearish candle. We've challenged that. We failed at that level. The market's turned around and started moving towards the downward side. A little bit of a glimmer there last night in that we've formed a candle with a reasonably long tail, a pin bar. we really need to start seeing the market finding some demand, some levels of support, and just see where that takes us to next. I'm really curious as to what the next move up is going to look like, and whether or not we start to form or start to remain in what is effectively a downward channel as well. I'll just draw that on for everybody at this stage. Hopefully my Beyond Charts is kind of working reasonably at this point in time. And if I just draw in a bit of a parallel line there, you can probably see that we've got, I'll just extend that a little bit sort of down at this point in time, where we've got bottoms and tops in here. We've hit the top part of the channel there. We're right in the middle at the moment, and it's sort of 50-50 as to which way this market's going to move. And I think Jeff will probably talk a little bit about this just coming up. But we really need to get back up to this 460 level at the very least, get a close outside of that before I see any sort of resemblance of an upward move again. Certainly things are looking pretty bearish, and our market risk indicator is just starting to roll over again a little bit as well. So certainly things are very bearish on the markets at the moment. You should only have a small amount of your capital exposed as we speak, unless of course you happen to be in a couple of trades that are still motoring along in the right direction. And if that's the case, keep managing as per normal. Jeff, the week ahead, there's a lot of news coming out of the US in particular. What's your take on the important events for next week?
Yeah, look, let's start off in the US, because so obviously at the moment in the US it's all about interest rates, and to be honest, the Fed is I guess playing with the market's heartstrings a little bit. If you go back a couple of years ago, when Bernanke was still in charge, he was actually he would go out and put out some language to say that, look, we're going to need to start raising rates soon, and the market would panic. That would be his official announcement. The market would panic, and then the next time he had the opportunity to talk to Congress or in an interview, he would say, "Oh, actually, don't worry. It'll be a while. There's no rush." And he would say one thing and then move to calm the market to reassure them. And Janet Yellen has kind of doing the same thing, but with a slightly different proposition. So we talked about how earlier this month there was the big will they, won't they raise rates, and I said, look, the Fed will not raise rates in September, but they will probably come out and give some guidance of when they will. So they didn't raise rates, and they said they were worried about overseas markets like China, and there's some signs in the US, and so not raising rates is kind of good. But then the market kind of panicked and said, when is this going to happen? We can't keep on having this yes or no debate every month. We need to know what's going on. And if you're pushing it back, does that mean that the economy is stuffed?
Yeah.
And so the market is kind of saying, look, you're giving us some good news, but we're just not sure. So since then, Yellen has come back and sort of switched sides, say, look, we didn't think we were ready, but don't worry, we're almost ready. We're getting there. And kind of reassuring, playing off both sides, going, we're not going to raise rates, but we're definitely going to raise rates soon. And she's reiterated since then, look, we still think rates are going to go up this year. Next week, there's 4 different Fed members are making important speeches or interviews. One of them is directly on interest rates. One of them is directly on monetary policy. And they're going to, I think, do that counter argument where, a week ago they said, no, rates are not going anywhere, and now they're going to have to balance it with, hang on a second, we did say that, but they're going to go up soon.
Do you think they're fearful of just what the market's going to do when they say, right, we're going to raise interest rates? They're fearful of having a market meltdown that is perhaps not necessarily warranted?
Yes, I think so. And I think, their first reaction, their main motivation for interest rates should be its impact on the economy.
Yeah.
Is the economy strong enough to handle it, and what will the impact on the economy be?
Yeah.
And I think that's what's always driven their decision. But then the market reacts, and then they have a subsequent, consideration where they're going, oh, hang on a second, We're not just thinking about the economy. Now we have to worry about how to cushion the market. And I mean, as an investor, I'm glad they're looking after the market and they're trying to stop it from melting down. But I think, objectively, they're probably spending too much effort trying to reassure markets. I mean, they have been reassuring markets for years. And I think that's probably maybe too forefront, too much in the front of their minds.
Because it's not their job to look after the health of the stock market, is it?
No, look, I mean, if there is a financial market meltdown that leads to, that has economic implications, if everybody loses half their value and the stock market has a crash, then the economy follows.
Sure.
So they do have some responsibility, but I think they are spending so much time thinking about the implications for asset prices that's why they're caught in these two minds. And so, look, I think you'll find next week that they'll come out and they'll say, look, they'll be a bit more, they'll be leaning towards raising rates and give more of a guideline and some certainty, which is exactly what I said, leading up to this most recent one. They won't raise, but then they will give, I think they need to give firmer language if they don't raise, when they will.
Yeah. So just on that, at the moment, the US market is it really hasn't been doing a lot this last week, since the non-event of the, as you call it, not doing anything with rates. And since then, the market's probably waiting for this next week to come to see what sort of language is going to come out. What do you think the market's going to do? Do you think the market's going to settle down in terms of volatility, or do you think it's going to become more volatile?
I think in the first day or two after the Fed members speak next week, I think you'll get a bit of volatility as people are adjusting to that.
Yep.
Then once if there's some certainty in the language, if they give a bit of a roadmap, when someone gets a roadmap, they'll go, the market will, I won't say panic, but will react. There'll be a bit of volatility. Yep. After a couple of days, they'll go, okay, we at least know where we're going. Yep. And then I think we'll actually get the markets should be quite settled until December, when you have the next big will they, won't they debate. And that's obviously a fairly specific prediction, so I mean it's hard to say exactly what the market's doing, but if I had to guess, they'll come out with some guidance. The market will take a couple of days to adjust. The market might even be all over the shop, and then they'll go, okay, at least we know what's going on, and
some clarity in the market.
And I think you'll probably see markets be okay for the next couple of months after that.
Yeah, certainly one thing the markets don't like is uncertainty. And you've seen all that, the episodes in China just as examples, but certainly the US would be feeling exactly the same way.
And I think just on that uncertainty, I think we've gotten to the stage where a rate hike would actually be less of an impact. But I think the Fed probably just have to get it out of the way rather than string everyone along and just continually wondering what's happening.
Yeah, it's almost like being a parent and the kids going, well, just tell me what you want me to do,
or just give me my punishment rather than tell me that you will punish me one day and I'm walking around all day worrying how my parents going to get me.
Exactly.
It's just easier just to put it on the table and know everyone knows what you're dealing with.
Yep.
Obviously, Dave's got a couple of teenage daughters, so he's thinking about scaring them, I think.
Ah, dear, there we go. It's all in how you say it, Jeff. Australia, next week, retail sales, building approvals.
Look, interesting one. Building approvals, every month it just jumps up and down. We had a really strong reading last month, so we'll probably have a really weak one this month. And retail sales, a little bit the same. This is, don't want to dwell on it too long, but a couple of months ago we had data from the end of June. The budget had some tax breaks. Businesses went out, spent a bunch of money. Retail sales really strong. The next month they went backwards. Surprised everyone? Probably not me, because when you see a huge jump, the next month usually goes the other way. Yep. So I think we'll see it then go back to normal. So I think we'll see probably a decent jump this month.
Japan, I was reading some things the other day that there was some discussions there about Abenomics. I've got that term right?
Yeah.
And some social unrest and those sorts of things. The Japanese market at the moment, it certainly has come off a lot. You might remember at the beginning of the year, Jeff, EWJ was an ETF that was performing extremely well.
I think it had gone up 40%
Yeah.
in a sort of
Very
3 or 4 months, maybe.
very strong market, and we were talking about QE and all those sorts of things since then. What's behind the Japanese market move, other than the impact of China and uncertainty in the US? Is there something internally that you know about that is having an impact on their market, or do you think it's just global ramifications?
Oh, look, it's both.
Both.
Yeah, I mean, it's definitely both. I mean, certainly the scares we got between Greece and China have still being sort of felt, mostly China. So that's definitely impacted the overall picture.
Yep.
Specifically, Japan, though, I mean, they've got a number of things that are going on, very specific to Japan. They've introduced some taxes and changed some spending laws to try and get people to be spending money, stimulate the economy, to actually get some inflation happening. They've got a whole bunch of programs and stimulus that they have announced that they have to continue sort of rolling over, and so there's lots of uncertainty there about the effectiveness, and are they going to have to announce some more stimulus. I think ultimately they will, and I actually said probably Japan a couple of months ago. I started saying Japan and Europe, I think in sort of the last quarter of this year, will probably announce some more large-scale stimulus.
Yep.
I think that's probably still on the cards.
Okay. All right. Thank you for that insight there. Folks, that wraps it up for this particular week. Just a reminder, those of you in the Elite Traders Club, to join me on Monday morning at 9 a.m. for our regular weekly analysis session, so we catch up then. Other than that, folks, good luck to Hawthorn this weekend. Hopefully having a win over Freo. I know those of you over in the West are probably barracking for both Freo and West Coast. But that's it from me.
And that's it from me.
Catch up with you next week. Bye.
Thank you.